Hey everyone, Couch Investor here with another video for you today. In my last video, we talked about the Delta stock, as you can see here. It was the first part of a three-part series like we did with the cruise lines. You can see here. We talked about Royal Caribbean, Norwegian, and Carnival. In the middle, I put a video about Zoom and why I'm not buying Zoom. So if you want, go check that out. But today we're going to talk about another airline stock called Air Canada, because we can talk a lot about US companies, but it's also good to talk about European, Canadian companies, etc. For my last video, I'm debating between Boeing or Airbus. So if you want one of the two, please let me know down in the comments below. Again, I would also like to thank everyone that has been tuning in lately, subscribing and everything. I really appreciate it. And if you haven't subscribed, hit that subscribe button. I would really appreciate that. So let's get into it. So Air Canada currently going for around about $16.68, up 10% of today. But as you can see, year to date, it was $52. Its lowest point was I think around the you can see here $12 mark. So yeah, it's a big decline, but we can see that it has been going up all the way almost to $18, then gone back down a bit to 14.5, and now it's making its way back up to around 16.70, something like that. But that's only the price wise. We're gonna jump into the balance sheet right now. So ticker symbol AC. It's obviously not on the Nasdaq. It's in the Toronto Stock Exchange. Price, I wrote it down a couple of minutes ago, 16.72, but it always varies. And by the time this video goes live, hopefully today still, hopefully it will still be around those prices. P ratio of 3.07. No dividend payments. It has a 5-year average PE of 12.7, so far from the actual PE right now. Its earnings missed. I think they missed two of their last earnings. Yeah, two of their last earnings missed, but we will talk about that later. All-time high, 51, I think it was 52. Okay, let's jump into the balance sheet and financials. Now, cash, $5.82 billion, revenue, $19.13 billion, cost of revenue, 14.53, gross profit of $4.6 billion, total operating expenses of 4.6, no, 4.6 was gross profit, sorry, total operating expense of almost $3 billion, operating income, 1.65 billion, is okay, not great. Cash and assets, again, cash 5.88, receivables 926 million, inventory 212 million, prepaid expenses 332 million, and the total is $7.5 billion. As you can see, it's a much larger, smaller than our last one, Delta. Delta had bigger numbers, but Delta also has well, huge liabilities and debt, which Air Canada does not have, as you can see here. Property, $22.9 billion. Depreciation minus $10 billion, which is a net of 12.7 approximately. Intangible asset, $1 billion. Others is 2.49 billion, which is a total of $24.4 billion. Now liabilities, it's okay. Short term, 7.7 billion. Long term, $15.58 billion, which is a total of $23.35 billion. Gross margin, very good, 24%. Operating margins is 8.6, which is around the average good operating margin. Now liability breakdown, short-term 587 million, no accounts payable, no accrued liabilities, deferred revenue 4.1 billion, which is a big one, and a total of 7.77 billion because of some other small one that add up. I wouldn't add everything because then our list would be very, very long. Now, again, you can see here it has a total of 24.4 billion in non-cash assets plus 7.5 billion. So their balance sheets are quite good compared to the others. So that's one very positive point. Stock repurchasing, again, very small. Let's change that to an orange color. 373 million of stock repurchasing, which is I think 1/3 of what, if not more than what Delta did. Last year's earnings per share was for 5.44 Canadian dollars. They have 270 million shares outstanding, but this year their projected earnings per share is a minus $10 for this year. Dividends is zero. I don't know why that's 40 cents. Dividends is zero. Current valuation is 4.39 billion. Earnings last year were 1.48 billion. Valuation versus previous earning, which is a total return on investment if you buy it at this price, in 2.96 years, so almost 3 years, let's say. Current reflections of earnings, I came out at $345. How do you calculate this? You take the current valuation, you divide it by the 5 years average PE, then you get a number, which is usually this one, and then you take that divided by their last earnings, and you will get the current reflection on earnings, which is $345 million. If you believe the company in the future would produce, let's say, more than $345 million, then it's a good time to start buying the stock. As you can see, last year's was almost $1.5 billion. But that's in a bullish case, very hypothetical. That's if the company can go back to their normal activities, then you get it at a big discount. Now, if you want, we can calculate the PE ratio, not the one that's currently here, but the one that's going to reflect the minus $10 earnings per share. Let's take our calculator right here, and let's do market valuation of $4.39 billion. Divide that by the earnings, which is 1.48 billion, and I think, no, my mistake. You have to first the shares. Let's do this. Cannot divide by 0, of course not. 270 million times that's a minus $10. We all know what it is. It's 2.7 million. It would put her in billions here. So that's the earnings for this year, because it's a minus $10. So 270 million shares. It's basically divided by 10. It's 2.7 million. So you can take the current market valuation, 4.3 billion, divide that by 2.7 million. Comes at around 1,625. Obviously, that's a very harsh case, because I think minus $10 per share is very bearish. Obviously, it's not going to be 5.44 Canadian dollars, but I don't think it's going to be minus $10. So obviously, if you're buying right now, just know that you're buying it knowing you could have a minus $10 earning per share in 2020. But I wouldn't go that much into it because, well, it's speculations, which only time will tell. That will be all for the balance sheet. We can go look at some of the articles. I think we should start with this one. Air Canada to reduce workforce by 16,500 as it parks plane during COVID-19. This is an article from Financial Post. Obviously, okay, it's a week old, but still very actual. Obviously, with the flights not operating, the company will decide to reduce its workforce, so it pays less salaries, etc. Air Canada Chief Executive Callan Rovanescu, this guy, I understand and regret the impact this will have, but I don't think he really has a choice right now, because they're losing millions and millions every day by staying on the ground. If you want to go over the article, I will put it down in the description below. But here, let's read this one. On Monday, Prime Minister Justin Trudeau announced the government will subsidize 75% of wages for companies that lose 30% of their revenue during a shutdown. It's not yet clear how Air Canada could benefit from this, but the airline said it will assess how the subsidy could affect its workforce reduction plan. Obviously, the airline industry gets hit very, very strong. Layoffs are inevitable, so if they can get help from the government, they might reduce their workforce, maybe a bit less than 16,500, but we won't know. This was posted on April 3rd. That's CBC Canada. Air Canada to provide protective gowns, eyewear to flight crew. They're still flying. I think only domestic flights. This is how it will look, and how it looks actually. Pretty scary, but there's not much to do. Here you can see a conversation that they have. I've asked several times, why are we not wearing hazmat suits? Other airlines are wearing it. Obviously, people want to work, but they want to work in a safe environment. So here you can see, reacting to Friday's announcement, a flight attendant who previously spoke to CBC News said that they were elated. It changes my level of confidence in the protection of my own health and that of those around me. So yeah, basically, if they can go to work knowing that they protect their own health and the one of the passengers, I think there could be a workaround, but still the passengers might be infected and infect others. So it's very difficult situation if you need to take a flight. If you don't need to take a flight, don't take a flight necessarily. Another negative article. Pretty afraid of the cash crunch. Here, Air Canada faces a severe cash crunch. Most of its profitable routes are shut down. Obviously, the airline has more than 5.8 billion in current assets, but it also had more than 7 billion in current liability. We saw that, but still, their balance sheet is so much smaller and better than the other airlines that I think they will survive, especially because they're really close with the Canadian government. They would probably maybe not need a bailout, but maybe a loan of some sort. Salaries and wages will remain top concern for 2020. Obviously, they don't want to let people go, but if they don't have a choice, that's what's going to happen. Again, if you want to read the whole article in detail, I will leave it down in the description below. In 2008, they got hit very hard. They needed a hard bailout, but obviously this doesn't make us very happy, but that's the current situation. But now they're in a much better situation than what they were in 2008. In 2008, people lost so much money, not because of health issue, but banks were shutting down. Money that they were promised never existed, disappeared. Companies were very unhealthy. And nowadays, banks have a lot of cash. That's one good thing, because bank can help out companies and then get a stake in a company or whatever. Which was not the case in 2008. 2008, it was government help or everybody's going, shutting down. That's very different from what's happening now, in my opinion, that is. Now, positive article is that last year they talked about an acquisition, Air Canada and Transat. They want to merge, but there's a big but here. Obviously, now with the coronavirus, it might get delayed, but the Competition Bureau announced today it has concluded that Air Canada's proposed acquisition of Transat is likely to result in a substantial lessening of prevention of competition in the sale of air travel or vacation packages to Canadians. Obviously, Canada, I don't think we know that, it's not like in the United States where there is Delta, United, American Airlines, Southwest, JetBlue, or whatever. There's a lot. In Canada, there's much less. And now with the big one buying a smaller one, there's less competition, so prices might rise. People don't have a lot of choice, so they can do whatever they want. They can put prices through the roof, and obviously, in an open market, that's not the best thing for the consumer, of people like us that like to travel. That's not going to be very, very positive. But I think overall, for the company itself and for an investor, this is good news, because they're going to have a bigger piece of the pie. And again, I think Air Canada's balance sheet is very healthy, even though it doesn't look like that. I think they're in a much better position than its peers. So for me, obviously, I would like to add it to my portfolio, but I would suggest to wait for maybe for it to come down to around 15 again, because I don't like to buy stocks that jumped, I don't know, 30% in 2 days or so. So I would look for a retest of this one here between 14.50 and 15. Would be a good entry point. Even now is a good entry point, because if it goes back to 52, you've tripled your money. You should be happy. And yeah, I think that would be all for today. Again, for my next video, if you want me to do about Boeing or Airbus, let me know in the comments down below. Don't forget to like, comment, and subscribe. Hit that subscribe button. Would really appreciate it. And yeah, if you have any suggestions for future videos, I know some people want to talk about the hospitality industry, so Hyatt, Hilton. I will add one of my own, which is a ticker symbol PK, Parks and Resorts. It's a real estate investment trust that was founded in 2017. It's actually a spin-off of Hilton Incorporated. So their holdings will be in there. It's also a cheap stock right now, very good dividend. So yeah, that might be our next series. But again, leave it down in the comments below if you have any specific stock that you want to cover. I know in some videos people commented if I can look at I think Toll Brothers or whatever. So I looked it up. I answered him in the comments. He was very happy. So I don't mind. Like, I will read most of the comments anyways. So everything is welcome. And yeah, see you all in the next video. Bye bye.